Hi guys, I welcome you in this wonderful video. So today I'm going to be sharing with you how to correctly use stop loss and take profit to exit your trade. So there are a lot of things that have been shared in terms of where to position your stop loss or how to use your stop loss and take profit, but I'm going to be sharing with you a different approach which works better for me. I know it will be a little bit different to what a lot of people recommend, but I assure you this is the best approach, or this is the best method to apply stop loss and take profit in your trading. So without any waste of time, let us just get started. So here we are, the market is moving in a downtrend. We can see through these lower highs and lower lows. So let's say you decide to enter your market going down. Let's say you analyze, you see that there's a impulsive and then there is a corrective. You try to understand the pattern of the corrective and you see that it's indeed in a form of a flag, and then you know that the recommended approach, it is to wait for the market to break out the pattern and then you execute your trade. So let's say you execute your trade after this minor retest, which retested these two lows. So you decide to execute your sell somewhere around here. And then the question is, okay, I've executed my sell, where should I place my stop loss? A lot of people will recommend that you place your stop loss above the recent high, which doesn't make sense practically, but it makes sense in theory. But here they mean that you should put your stop loss all the way up there, which is not reasonable, because can you just see the difference between your entry point and where you are positioning your stop loss? And even when it comes to entering, you're not just going to be entering here, you'll be entering somewhere around here. So you can see the difference, that it's huge. So what I recommend in terms of price action is that before you place your stop loss, make sure that you don't place your stop loss based on what you want to risk. What you want to risk should be a limit. Let's say you are risking 1 to make 3. This one should not be always where you place your stop loss, but it should be a limit that I'm not going to risk more than 1%. But it doesn't mean that in every particular trade I have to try to position my stop loss where I'm going to lose 1%. You're going to be putting your account in a disadvantaged position, because sometimes it's easy to exit before the price hits the 1% mark. For an example, when you enter a trade, before you put a stop loss, observe what influenced you or what forced you to execute that trade. In our case, it was the breakout of these corrective pattern, or this corrective wave, which represented itself as a flag pattern. So then, because we have now observed what made us to enter, which was a breakout, we know where should our stop loss be, because this pattern should act as a border or as a barrier for our stop loss. Why? Because if you exit here after the breakout and the retest, you are telling us, or you are telling the market that, hey, price action, I'm not expecting you to go back to that position because of this breakout. I know that you are not like to go back there. So when I position my stop loss, I will make sure that I position my stop loss somewhere below this line, or this breakout line, maybe all the way below, because I am not expecting price to go back inside that corrective pattern. So I hope that is making sense. You don't look at the recent high, but you look at the price action that forced you to enter or execute that trade, and then you treat that pattern as a barrier that I'm not gonna go inside or beyond that pattern. Meaning here in this scenario, we are expecting a stop loss to be below these broken upward minor trend line. So we're expecting your stop loss to be all the way below here. It can be somewhere around here, and if it's somewhere around here, at least now you are risking something reasonable. You are no longer risking something more. At least you are risking something which is very, very limited. I hope that is making sense. And why should you use this method? It's because if you use, let me just clear some of the drawings here. If you use the traditional method of putting a stop loss above the recent high, it means that you are not sure of the decision that you have made all the way down here. Because if you're sure of the sell that we've made here, there's no way where you can position a stop loss all the way above there, because you know, or you are confident that price is not likely to go back inside the pattern, then if you're confident that price is not likely to go inside the pattern, then put your stop loss just below the pattern that you used to enter, or just below the breakout that influenced you to enter. I hope that is making sense. Let us go to the next part, which is take profit. When it comes to take profit, let me again clean my screen a little bit. When it comes to take profit, guys, I will again emphasize on this point of risk to reward. Let's say you risk 1% to make 3. Don't treat these numbers as your targets or as your barriers. I did explain on the stop loss that this 1% is a limit, that I don't go beyond it, but it doesn't mean that it's a constant or it's a fixed number. It's a limit that I don't go beyond it. And this 3% is not a number that you should aim for, but it's at least a number that you should fall onto if maybe the market is not favoring you at that moment. And even if the market is not favoring you at that moment, don't force yourself to hit 3% or to make a profit which is 3% of the capital that you have. This number is just there to sometimes remind you that, hey guy, you have to aim for big profits, not that you have to go for 3% all the time. There's a point where the market is gonna offer you 6%. Are you gonna leave it and just go for 3? There will be a time where the market is gonna offer you only 2. Are you gonna risk and lose this 2 because you didn't want it? Your aim was on 3%. So you have to use these numbers very, very careful. They are just there to remind you that when you take a loss, make sure that you take a loss that is smaller than the profit that you usually take. So here we are. Let's say you execute your trade again as a sell here, and then the question is, where am I expected to position my beautiful take profit? The answer is, we don't actually know where price is gonna reverse, but we can figure out where price is likely to reverse. I hope that is making sense. We don't know where it's going to reverse, but we can try to figure out where it's likely to reverse, and then we're going to use that area as our stop loss. What is the first thing that you can use, or the first approach to use when you want to figure out where price is likely to reverse? Firstly, you have to analyze the trend that you are trading and try to detect how the waves are behaving. Let me just clarify that. Firstly, we have this impulsive wave, and we know that in a healthy trend, usually the impulsive waves, they are the same, or they get bigger and bigger, but they don't get smaller and smaller unless that trend is likely to reverse. So meaning you should use your previous impulsive, let me just make it a little bit more colorful like that. You should use your recent impulsive as your guide. I'm gonna recommend another method, but I'm just gonna start with a simple one. You have to check the flow of the market and check your previous impulsives and use them as a guide. What do I mean? In a good trend, the next impulsive is likely gonna be the same size as the previous one or bigger than the previous one. Let me just duplicate this here and then drag it here. Do you see that these impulsive waves are the same? Or let me say are almost the same size. If I put it here, you can see that they are almost the same. It means that it's a healthy trend. And even the correctives, let me just put this one there like that, and then I'm forced to use a different color. Let me use the blue one, and then if I duplicate here, you can see that even the corrective waves, they are the same size. It's a trend. That's how a trend behaves. So by understanding the size of the previous impulsive, you will know that, oh, I am likely to receive an impulsive that is at this size. So you can put it here and know that, okay, somewhere around there I am gonna expect the market to reverse, or depending where you put it. If you put it there, you know that somewhere around this price or this level, I'm expecting the market to reverse. So you know that, okay, firstly, I'm gonna put my stop loss around this level, my take profit around this level, and then you can drag it and put it there. It's better, guys. Why? Because you still risk less than you can make. Remember that our stop loss is gonna be somewhere below there, and then look where your take profit is. You are still risking less. It's like a kind of like 1 to 4 risk reward. You're like risking 1 to make 4. So when you position your take profit there, you at least you at least try to observe how the market was flowing. And then the next method which I recommend is to use tools, for an example like the Fibonacci extension. If you can't easily detect where the market is likely to reverse, the Fibonacci extension is there to show you something like that. For example, you can place it there and then place it on your low, on a recent low, and then drag it to the most recent high or to the high that you entered from, and then pull it horizontal like that, and then see it is showing you exactly where price bounced. So these numbers are showing you where price like to reverse, this one and that one. We cannot pay much attention into these ones because they are so close to our entry area, but these and this one, they're showing you where price was like to reverse. Then you know that you're gonna expect to exit when price approaches this level. However, here is another important method that I use, and this one, it is the very, very effective one. It is to observe the flow of the price. Let me erase some few drawings here. It is to observe the flow of the price and then respond to the price. Respond to how the price is behaving. Let's say you are riding your sell, you are excited, profits are growing, and then you observe the market entering in transition, giving you a high, and then okay, you don't mind this, you just continue to wait, and then it gives you this, which is a low that is at the same size as the previous minor low, which is something interesting because it might indicate that okay, now price is entering in a corrective, and if price is entering in a corrective, then you need to know that okay, now it's the time to exit. Why? Because you just saw this, and then this told you that okay, now we are entering in a corrective, and then from this, that's where you can cut your profits and say okay, I'm getting out. One thing that I'm not going to explain in this video because this video is already long and it is only dedicated to take profit and stop loss. Another thing is that you can scale your trades, meaning you cannot exit when the price enters a corrective. You can just wait and try to understand when the next impulsive come so that you take advantage of it as well. Meaning you will not exit here, but you're gonna wait and maybe try to exit on the next transition like that. But this video is not for that, so I'm just gonna leave it here, guys. Thank you for watching this video.